Startup failures have wiped out over $1 trillion in investor value globally over the past decade. And the surprising part is, many of those companies didn't run out of money. In fact, they were among the best funded in history. Billions of dollars raised, billion-dollar valuations, global headlines, and then complete collapse. Because raising too much money doesn't just fund growth, it can fund bad decisions faster. Today, we'll break down the dark side of raising too much funding and the lessons every founder and investor needs to learn. When startups raise large amounts of capital, something subtle but dangerous happens. They stop optimizing for survival and become obsessed with speed. Instead of asking how do we build a sustainable business, they ask how do we grow fast enough to justify this valuation. And that single shift changes everything. Expansion begins before the model is proven. Profitability quietly moves to later. Because when you're sitting on billions, slowing down feels like a failure. And no company illustrates it better than WeWork. At a point, WeWork looked unstoppable. It raised over $12 billion, backed by investors including SoftBank. At its peak in 2019, the company was valued at $47 billion. But beneath the surface, the business was deeply flawed. WeWork signed long-term leases with fixed costs and then rented them out short-term to customers on flexible contracts. Instead of fixing the model, WeWork went all in on expansion. They built luxury offices worldwide and scaled to 800 plus locations, expanded into over 35 countries, and hired a pace few startups could even imagine. Founder Adam Newman believed scale would solve the problems, but it didn't. When investors finally examined the fundamentals, confidence collapsed. WeWork's valuation fell from $47 billion to under $10 billion. And the company filed for bankruptcy in 2023. Too much funding allowed the company to scale its weaknesses, and the same pattern showed up again with Quibi, one of the fastest startup failures in history. It raised $1.75 billion before launching a single product. The founders believed premium short-form video would dominate mobile entertainment. They spent heavily on celebrity shows, Hollywood production, and massive marketing campaigns. But they ignored a simple reality. Users were already getting free content on platforms like YouTube and TikTok. Quibi shut down in just 6 months after its launch, and nearly $2 billion is gone. They failed because funding created false confidence. Instead of testing small and learning fast, they bet everything up front. Now, let's take one more powerful example. And it's of Theranos. Theranos raised over $700 million and reached $9 billion valuation. The company promised revolutionary blood testing technology. Investors believed it would transform healthcare. But the technology didn't work. The funding allowed the company to continue operating and expanding without solving the core problem. Instead of fixing the product, the company scaled the illusion. Eventually, Theranos collapsed completely, one of the biggest startup frauds in history. Funding just delayed its failure. And across all these examples, one question keeps surfacing. Why is too much funding so dangerous? Because it quietly changes startup behavior. First, it removes urgency, because startups stop focusing on survival and start assuming the runway will save them. Second, it encourages waste because money gets spent on growth experiments that were never properly validated. Third, it hides product problems because funding can temporarily mask a weak business model. Fourth, it creates unrealistic expectations because valuations begin growing faster than real fundamentals. Fifth, it makes failure bigger because more money does not prevent failure, it amplifies it. Also, ironically, many of the most successful startups like Mailchimp, Basecamp, Audacious, Zoho, and Shutterstock raised little or no external funding in their early years because they focused on efficiency. They built strong foundations. They proved their model before scaling. Because the goal isn't to raise money. The goal is to build a sustainable business. The best startups don't raise the most money. They use money the most wisely. Because in the end, discipline, not funding, is what builds lasting companies. If you liked this breakdown, like, share and subscribe for more startup realities. And if you're building something serious and want smart capital, Exit Fund is here to help. Know more at exitfund.com.